Investment process for HDB shophouses by a Singapore ACRA registered investment holding company. Introduction. HDB shophouses are a unique asset class in Singapore's property market, offering a combination of commercial and residential use. These properties are often located in mature estates with high foot traffic, making them attractive to investors seeking rental income and long-term capital appreciation. For a Singapore-registered investment holding company, the process of acquiring an HDB shophouse involves regulatory approvals, financing arrangements, and compliance with HDB policies. Understanding the investment process is crucial to ensure a smooth transaction while maximizing potential returns. Eligibility and regulatory considerations. HDB shophouses are classified into two categories: purely commercial shophouses and mixed-use residential commercial shophouses. An investment holding company registered with ACRA is eligible to purchase only commercial HDB shophouses, as residential components in mixed-use shophouses are typically restricted to individual buyers or entities approved by HDB. Before proceeding with the purchase, the company must ensure that it is registered with an appropriate SSIC code related to property investment or holding activities. Additionally, it is essential to check the zoning regulations set by URA and HDB to confirm that the intended use aligns with existing policies. Financing the investment. Investment holding companies typically finance HDB shophouse acquisitions through a combination of bank loans and company funds. Banks generally offer financing of up to 80% of the property's valuation, subject to the company's credit assessment and financial standing. Interest rates for corporate property loans may be slightly higher compared to individual property loans. If the shophouse is subject to Goods and Services Tax, GST, the company must be GST registered to claim input tax credits. Additionally, companies should consider factors such as cash flow management and loan repayment obligations when structuring their financing strategy. The investment process. The process of acquiring an HDB shophouse begins with identifying a suitable property that meets the company's investment objectives. Key factors to consider include location, rental yield potential, existing tenancy agreements, and lease tenure, as most HDB shophouses are on 99-year leases. Once a suitable property is identified, the next step involves securing an option to purchase, OTP, from the seller by paying an option fee, usually 1% of the purchase price. Before proceeding with the purchase, due diligence must be conducted to verify the property's legal status, compliance with regulations, and any outstanding liabilities. The company must also seek approval from HDB for the transfer of ownership, as all HDB shophouse transactions require regulatory clearance. Once the due diligence is completed, financing arrangements must be finalized before exercising the OTP, which requires paying the remaining 4% deposit within the stipulated period. The legal conveyancing process follows, where the company's appointed legal representatives handle the title transfer, payment of applicable stamp duties, and other necessary documentation. The entire process, from securing the OTP to completion, typically takes between 8 to 12 weeks. Stamp duties and tax considerations. When purchasing an HDB shophouse, the company is required to pay buyer's stamp duty, BSD, which is calculated on a tiered basis: 1% on the first $180,000, 2% on the next $180,000, 3% on the next $640,000, and 4% on any remaining amount. However, additional buyer's stamp duty, ABSD, does not apply to HDB commercial shophouses, making them an attractive option for corporate investors. In terms of ongoing costs, property tax for non-owner-occupied commercial properties is typically set at 10% of the annual value. If the company generates rental income from the property, it will be subject to corporate tax at 17%. Managing the investment. Once the acquisition is completed, the investment holding company can either lease the shophouse to commercial tenants or operate its own business within the premises. Effective rental management is crucial to ensure stable cash flow and optimal returns. This includes securing long-term tenants, maintaining competitive rental rates, and ensuring compliance with HDB's regulations on permitted property use. Companies must also be mindful of regulatory requirements such as renewing business licenses and adhering to URA guidelines on land use. As part of the investment strategy, the company may consider selling the property after a period of appreciation or reinvesting in another asset to diversify its portfolio. Conclusion. Investing in an HDB shophouse through a Singapore-registered investment holding company presents opportunities for stable rental income and long-term capital growth. However, companies must navigate regulatory requirements, financing considerations, and tax obligations to ensure a successful transaction. A well-planned investment approach, supported by thorough due diligence and financial structuring, will enable investors to maximize the benefits of HDB shophouse ownership while mitigating potential risks.